Good morning, students. Now we can start accounting and finance, which is one of the important subject of UGC. In every UGC examination, accounting and finance is a backbone or basics of the examination. Without accountancy, without commerce, that is the main concept. That will be our main concept. Accounting and finance will be the most important subject of our aim. Without accountancy, you cannot pass UGC December 2018 examination. So, we can start. First of all, we have to consider what is the difference between bookkeeping and accounting. The term accounting starts from the concept bookkeeping. Accounting is an expansion of bookkeeping. Then what is bookkeeping? Bookkeeping is the recording of business transaction. Then accountancy is the actual recording of business transaction. Then what is the difference between bookkeeping and accountancy? If bookkeeping work is done by a non-qualified accountant, it will be certainly bookkeeping. If the recording transaction is done by a qualified accountant, it will be accountancy. Then the mere recording of business transaction is known as bookkeeping. On the other hand, the actual recording of business transaction, the preparation of financial statements, and the analysis and interpretation of financial statements on the basis of generally accepted accounting principles and accounting standards of relevant bodies is known as accountancy. If you are an accountant, you will be a qualified accountant. Otherwise, your accounting work will be only bookkeeping. There are certain principles or concepts which have to be learned before you starting the actual recorded business transaction. Otherwise, your accounting is only bookkeeping, not accountancy, only bookkeeping. Actual recording of business transaction, preparation and analysis and interpretation of financial statements is known as accountancy. So, accountancy is a very important subject. Not only financial accounting, but also cost accounting and management accounting are the other important terms of accounting terminology. Actually, cost accounting and management accounting is an expansion of financial accounting. After the preparation of financial statements, the work of cost accounting and management accounting will start. Then, if you have to start cost accounting and management accounting work, first of all, you have to complete the financial accounting works. That means the preparation of financial statements. Up to the preparation of financial statements is known as financial accounting. After the preparation of financial accounting, the work of cost accounting and management accounting starts. Then, first of all, you have to learn the basic terminology of accounting. What are the basic terminology of accounting? There are a lot of terms which are so useful in our accounting and accounting profession. What are the basic accounting terms? The basic accounting terms are, first one is business transaction. What is business transaction? Business transactions refers to any business dealing or event which has a value measurable in terms of money. Apart from business transaction, there are a lot of basic accounting terms. First of all, financial statements. Financial statements may be trading account, profit and loss account, and balance sheet. So, there are three important financial statements as per generally accepted accounting principles of India. First one is trading account, second one is profit and loss account, and third one is balance sheet. Then another important concept is asset. What are asset? Asset means material things or possessions or properties of business, including the amounts due to it from others. There are two different types of asset. First one is fixed asset and second one is current asset. What is fixed asset? Fixed asset means those assets which are acquired for relatively longer period. Those are known as fixed asset. Examples of fixed asset are tangible asset, intangible asset, vesting asset and fictitious asset. Then there is another term which is current assets. What is current asset? Current asset means cash are equal, cash and those assets which are equivalent to cash are known as current asset. Examples of current assets are cash in hand, cash at bank, debtors, bills receivable, prepaid expenditure, etc. So we can classify asset into two. First is fixed asset and second is current asset. Then liabilities. Liabilities is another important accounting concept. What is liability? Liability may be current liability and long-term liability. What is current liability? Current liabilities are those liabilities which become due and payable within a period of 1 year. Is known as current liability. What is fixed liability? Fixed liabilities are those liabilities which are payable after a long period. Then another term is capital. What is capital? In every accounting transaction, there is a concept which is known as accounting equation. Accounting equation is the basis of our double entry accounting. Then capital. What is capital? On the basis of accounting equation, asset is equal to capital plus liabilities. Then what is capital? Capital is equal to asset minus liabilities. So capital is equal to asset minus liabilities. That is capital. On the basis of accounting equation, capital is equal to asset minus liabilities is equal to capital. So we have to understand what is double entry accounting and single entry accounting. There are two different modes of accounting. First is single entry accounting and second is double entry accounting. What is single entry accounting? Single entry accounting means an accounting system which is not based on accounting principles, or it is a system which is not based on generally accepted accounting principles of India, which is known as single entry system. Then what is double entry system? If an accounting system which is based on generally accepted accounting principles of India, that type of accounting system is known as double entry accounting. In double entry accounting, every transaction has two aspects. One aspect is a giving aspect and another aspect is a receiving aspect. You may call one aspect is debit and another aspect is credit. So as per double entry account system, there are two aspects which may be related to every transaction. One aspect you may call debit and one aspect you may call credit. On the basis of modern approach, American accounting system, we can summarize all items in accountancy into 5 distinct terms. First one is expenditure, second one is income, third one is asset, fourth one is liability, then last one is capital. So you have to understand the debit and credit aspect of expenditure, asset, income, liability and capital. If you can learn or if you can understand the debit and credit aspect of these distinct 5 terms, then the subject of accountancy will be very easier to you. So first you have to understand the debit and credit aspect of expenditure. As per American accounting system, if an increase in expenditure is occurred, you may debit that expenditure. On the other hand, if a decrease in expenditure is occurred, you may credit that item. On the similar lines, if an increase in asset is occurred, you may debit that item. On the other hand, if a decrease in asset is occurred, you may credit that item. So, the treatment of expenditure, asset and drawings are equal, are on similar lines. On the other hand, the treatment of liabilities and capital and incomes are, if an increase in expenditure is occurred, you should credit that income. On the other hand, if a decrease in liabilities occurred, you should debit that income. On the similar lines, if an increase in liabilities occurred, you may credit that item. On the other hand, if a decrease in liability is occurred, you may debit that item. On similar lines, the treatment of capital is like the treatment of liabilities and income. So, on the basis of American accounting concept or modern approach, all accounting transactions are to be inserted in a book which can be called journal, is on the above lines. So, you have to master the debit and credit aspect of asset, expenditure, income, liability and capital. It is very necessary to start the job of an accountant, or it is very necessary to study before the subject accountancy. Then, what is drawings? Drawings means the amount of cash or other asset withdrawn by the proprietor for his personal purposes. That is known as drawings. Drawings is just opposite to the capital. Capital is the investment in business. On the other hand, drawing is the withdrawing amount withdrawn by the owner for his personal purpose. Then, another important term is expenditure, revenue, losses are the other important terms in every accounting terminology. Expenditure, what is expenditure? Expenditure means expense. We may classify expenditure into two. First one is capital expenditure and second one is revenue expenditure. What is capital expenditure? Capital expenditure means the cost of fixed asset is known as capital expenditure. So, the cost of plant, the cost of patent, goodwill, etc. is known as capital expenditure. What is revenue expenditure? Revenue expenditure means the day-to-day expenditure you have to incur for the successful conduct of your business organization. That is known as revenue expenditure. What are the examples of revenue expenditure? Salaries and wages, telephone charges, advertising, printing and stationery, etc. are known as revenue expenditure. Then, there is a concept which is loss. What is loss? Loss means revenue minus expenditure is termed as loss. On the other hand, revenue minus expenditure is known as profit or gain. Expenditure minus revenue is known as loss. Then, purchases, sales, stock, debtors, creditors, accounts receivable, accounts payable are the other important term in every accounting terminology. What is stock? Stock may be opening stock and closed stock. Closed stock means the goods lying with a business for sale on any given date is known as closing stock. Then, debtors and creditors. Debtor is a person who owes money to the business. On the other hand, creditor is a person to whom business owes money. So we have to consider the generally accepted accounting principles. Generally accepted accounting principle is the backbone or basis of accountancy. Generally accepted accounting principles may be classified as assumption or concept, principles or convention, modifying principles, and accounting standards. First of all, assumption or concept. Accounting entity concept, going concern concept, money measurement concept, and accounting period are the widely used accounting concept. Then next classification is principles or convention. Revenue realization, verifiability or objectivity, matching, full disclosure, dual aspect, historical cost are the widely used principles or convention. Then there is modifying principles, materiality, consistency, conservatism, practice in industries, etc. are known as modifying principles. Apart from assumptions, concept, principles, conventions, and modifying principles, there is a term which is known as accounting standard. Accounting standard means accounting standard issued by Accounting Standard Board of India. Now every talk is going on about accounting standards. Accounting standard is very important. Now all accounting work is based on accounting standard, assumptions and concept, principles and conventions, modifying principles are to be studied before studying about accounting standards. So the theory based accounting will start in next class. Thank you.